Okay, good evening guys. Before we start, as always, let's do our customer instant poll. Let's check that everyone can hear the volume correctly tonight. I'm going to put this on your screens now. Please indicate if you can hear the sound perfectly, too loud or too low. Just indicate by pressing 1, 2 or 3. Okay, the majority of people are saying perfect so far. If that's good enough for you guys, I think we can get started. Thanks for that. Okay guys, what we're going to talk about tonight is all about oil trading. So a very volatile contract, lots of opportunities. Obviously it's a commodity, very driven by fundamental information. Now before I start, as always, you need to read the risk warning. Now spread betting and CFD trading both carry a high level of risk to your capital, with the possibility of losing more than your initial investment. These products may not be suitable for all investors and are only intended for people over the age of 18. Please ensure you're fully aware of the risks involved and if necessary seek independent financial advice. Again, this is educational only. The content of this webinar is the personal opinion of the moderator, not intertrader.com. The content does not constitute financial investment or tax advice. We recommend you discuss your specific requirements with an independent financial advisor prior to entering any bet. Intertrader.com does not accept any liability for the content or comments during this session. Okay guys, so when we talk about oil trading and we talk about oil itself, we have to understand that it truly is a global commodity. It's used in pretty much everything we do. From manufacturing to powering transportation to making different items. It really is involved in pretty much everything we do in one way or another. So when we're talking about production and consumption, obviously we realise that oil is a diminishing commodity, and it will eventually, as we've been told by the so-called experts, run out. Exactly when, we don't know. But again, we rely on the oil companies to tell us this, the government reports, etc., etc. But we know that at one point it is going to run out. So production-wise, generally we're doing around about 81, 82 million barrels a day, and we're consuming close to 84 million. So when you think about it, that's huge, huge quantities that A, is being produced in, but B, we're outstripping the production, always consuming and using more oil that's being produced on a daily basis. So very, very important that we understand that it's a globally traded, used commodity, and that it has a factor and an effect through so many different parts of the economy. The underlying, it's always going to have an effect and move other markets. That's why, when we talk about market analysts and we're speculating what the dollar's going to do, and again, we look at things like oil because again, it's traded in dollars, and again, we know that if oil price is high, it's going to have an effect. An effect on manufacturing, what we produce, people's ability to spend. So again, it's a very, very important factor in the global economy. So how is crude oil traded? Well, we generally refer to it in barrels. So 1 barrel would be the equivalent of 42 US gallons or 164 litres. So again, we talk about it in in terms of barrels, but generally it never sees the inside of barrels these days. It's always on and off vessels and transported in huge, huge quantities. So we talk about the production and transport of oil itself. It's no surprise that we see that the cheaper it is to produce, the more oil is produced. So again, that's why the first 3 blocks we see Saudi Arabia, the Middle East, and Russia. Okay, so it's very, very cheap for them to produce and transport oil around the world. Therefore, the cost is lower. When we go towards the other scale, and we have places like Canada and North America, very, very expensive to produce and therefore transport around the world. Therefore, it's not cost effective for these countries to produce as much oil. Okay, so again, it's not just the vast resources that Saudi Arabia and the Middle East have. Again, it all comes down to the cost versus production. So again, when we're talking about a geopolitical event, what's happening in the global economy and the stability of countries, we have to understand that anything that affects these countries' ability to supply the market with oil or to produce it will have a negative effect, make the price of oil go up. So again, if civil unrest breaks out, like we had the Arab Springs, for instance, if things like that break out again, there's going to be an underlying worry about the ability for the market to get hold of oil, so therefore the supply. The demand stays the same, therefore the price goes up. Very, very simple economics. But when we're talking about trading oil, again, we have to understand that it's very, very fundamentally driven by news, by government policy, by stability. Okay, it's not just a simple fact of supply and demand. Yes, all these underlying factors and the fear that drives the oil market. So when we talk about oil, we're generally referring to the benchmark, which is crude oil. So again, a term we should all be aware of. So again, it's a blend, and it's produced over 20 oil fields, and it's exported from the Solomon Voy oil terminal in the Shetland Isles. So again, Brent production is in declining, and in certain points, some of these terminals are doing less than 220,000 barrels a day. But again, I wouldn't pay too much attention to the individual companies that produce oil. There's government reports that we'll come to a little bit later on. They're probably a more unbiased view of what the actual industry is producing, what the stockpiles are. And again, when we talk about fundamental trading, these are the figures and these are the pieces of information that we have to pay particular close attention to, because again, they're not just directly for the oil market, but again, they're not they don't really have any bias in them, and it's not in anyone's interest to skew these figures. Okay, so then when we talk about other types of crude we might have heard of, obviously there's other crude oil that comes out of Kuwait and Dubai, and then there's obviously Bonny, which comes from Nigeria. So again, they're all different markets, but they all follow the underlying price of Brent crude. So again, when you look at the difference between Brent crude and things like the Kuwait oil, for instance, there's a difference of around about $6.25, whereas the Brent versus the Bonny is only a difference of $3.70. So again, you might ask yourself, well, why is that important? Well, later on in this presentation, we'll talk about arbitration, where we can trade one market against another. So again, oil is one of them rare products that it's got direct correlations and mirrors, so we can trade different oil types against the benchmark crude. But again, we'll go through that towards the end of the presentation. So another oil we should have heard of is the WTI, which is the West Texas Intermediate. So again, this is a composite blend produced from West Texas, hence for the name. Deliveries at Cushing, Oklahoma, or the Midland, Texas, in the U.S. oil pipeline system. So again, it's a physical crude, and it's used as a basis for NYMEX's light sweet crude contract. So NYMEX, again, another big live trading floor in the U.S. So again, when we talk about oil and we talk about how it's refined and the uses we get out of it, we have to understand the sheer importance and how many different factors that it really does break down into. So again, it's not anything that is generally produced at some point will have used some sort of oil in its production or its manufacturing, or whether the raw materials were produced, they have to be transported there by, again, train, plane, cars. And again, these all use oil. So when you talk about any kind of product, there's very, very few, if any, products on the planet that never require any kind of oil or its derivatives. So when we talk about refining crude, the main things we want to get are things like LPG, okay, so for heat generation in vehicles. So gasoline, obviously a huge one that we all know. We all know what's happening in the oil market by what's happening at the petrol pumps. Okay, they have a direct correlation. Unfortunately, when oil prices get smashed and come down quite rapidly, it doesn't as quickly filter through to petrol prices. But that's just the nature of the game, unfortunately. Then again, we want things like kerosene, we want jet fuel. We want things like gas, oil, and diesel for power generation and for vehicles. Then we have other kind of fuel oils for shipping fuel, etc. Then again, we have things like specialty products, so like naphtha, lube oil, waxes. Again, think about it. Think things like bitumen and coke. 5-10 years ago, when we were pumping loads of money into the EU, how much oil was used to produce all these roads in Portugal and Spain. Again, bitumen's heavily reliant on oil. So again, you have to think about the business climate, the economic climate. If we're in a rapid expansion, if we're making lots of new houses that need, again, bitumen for the roof, or we need, lots of office blocks, that require a lot of heavy, machinery that use lots of oil. So again, it's all the things we have to think about, what factors affect the global demand for oil. Okay. So we're talking about refining our crude and the distillate yields. These are the basic breakdowns of what we get in percentage-wise from these three particular products. So the WTI, Brent, and crude. So the best thing to do is look at things where there's a big variance. Okay. So most things like the fuel, oil, and loss are fairly close. But then if we look at something like naphtha, for instance. So again, the Saudi light is 17%, the WTI is 26. So again, if we're in a period of where we're in rapid expansion and we need to create a lot of infrastructure and roads, then maybe, you know, again, if we're getting a better distillate yield for this product out of WTI, then the price, therefore the demand, will go up because we want more of this product. Because again, a percentage yield, we get more of this product from that. So maybe we can do a hedge. We can buy the WTI because we know the demand for that product to go up. Then we can sell the Brent, the underlying, or more likely the Saudi light against it in order to make a hedge. So we know demand for one will go up. And again, if we know what business cycle we're in and the reasons why that's being demanded, therefore there should be less demand for the Saudi light. We can buy one contract and sell the other, and therefore have an arbitrage in the market and better use our capital. So again, when you buy one contract and sell another that's directly correlated, you're basically doubling your margin. So futures trading. So again, the futures market is very, very common and very important in the oil market. Again, because unlike most things, it's actually physically delivered. So again, if you're Richard Branson and you want to fill your planes up for the next 2 years, and you think oil is a particularly good price, you can go into the futures market and agree a future price or buy future contracts in order to lock in the price of that oil. So again, you can trade futures for most products apart from gas oil on the CME, because gas oil, again, quite a popular market currently. It hasn't been for a long time, but you hear a lot of people talking about it now. Now, the trouble with things like gas oil and the trouble with things like oil, it's great when it's trending and it's great when it's understandable and the market's moving in a controlled fashion, because it is so so fast moving. It can be quite illiquid. You can get huge spikes in oil. So if you're the wrong side of a position, you can get easily carted out. You can easily take in a position that you have to, quickly liquidize, because it takes on too much risk. So gas oil is a little bit different than trading oil because it is vastly more expensive. So the margins and the amount of capital you need to have on deposit in gas oil terms are a lot more than you need of oil. So again, that's why you don't see as many futures contracts traded. So technicals versus fundamentals. So the Dow theory states that the market discounts all news. It's very much like Adam Smith, a very old famous economist, that the market discounts all news and all information is reflected in the price. So all this means is that when the price is trading at market, that all the information is known. It's only when new fundamental news comes into the market and new technical levels tested. So again, if a pipeline breaks or BP have another tanker that sinks, yeah, that's new information, and the price of oil will react accordingly. But it will hit and test technical levels. So that's the technical versus the fundamentals. Oil, as we've just said, is very dependent on stability. It thrives on fear. So the more stable the economy is, the more we can predict things. The lower oil price is, the less we understand, the less confidence there is in these oil-producing nations and economies as a whole. Again, oil prices can go up. So that's the correlation. So that's why you have to understand how the markets are trading, and again, what fundamental news is driving the market, what fundamentals are making the market make its decisions and take its view on the relative price of oil. So as I said to you before, there are certain things we need to look at and be aware of that are very, very specific in the economic calendar that are to do with oil. So the Department of Energy is very, very important. Okay, now these figures are released weekly and usually Wednesday at 10:30 New York time. Okay, and what they do is they show the stats for the change in the previous week for crude and WTI, gasoline and distillates. Yeah, so again, it gives us good independent government stats of what's being produced. So we need to look at that and make our decisions based upon the releases of these figures. Then we have the API, which is the American Petroleum Institute, and these release their stock figures at 4 o'clock New York time. So it says that these are largely ignored by the market. Well, they're not ignored by the market at all. They might be ignored by the market in the wider sense, but anyone that trades oil is very interested. Again, when we're talking about stockpiles, the stock figures, we know that anything happened to the supply of oil, what's going to happen? Yeah, if anything comes in to disrupt that, the price will go up. So again, America has a huge stockpile of oil to kind of fade out any short-term problems we might have. So the lower that them stock figures are, the more susceptible we are to a spike in oil prices. So again, if you're trading oil, it's very relevant that we look for the API and the stock figures that we have on reserve. So again, when we look at the oil event calendar, it's quite easy when you look at InterTrader. It will tell you anything that's oil specific. And again, we have the IEA, the International Energy Agency, which release figures, and OPEC, which we've all heard of, the oil petroleum exporting countries. Again, any reports that come out from the IEA or OPEC are important. And again, any dovish or hawkish figures or comments that come out of these organisations, you can trade oil on the back of it accordingly. So just like any other economic figures that come out, but these again are oil specific. If the oil agencies say that, again, we're quite stable, we've got good supplies, and we don't see any change to that, then that's going to send the price of oil down. It's more stability in the market. Again, if they say anything hawkish and there's bad news into the market, there might be a disruption in supply, or they're worried about oil producing nations, the price of oil goes up. So again, it's something to be aware of and understand. It's an opportunity to make money. So this is just again a snapshot, a screenshot of the economic calendar. So again, anything to do with oil is generally starred up, and it will tell you what it relates to. So again, the economic calendar on InterTrader is quite comprehensive. And again, if you drill down, you can actually read into these figures, what's expected, and the build-up from the experts. So there's many other economic events which can affect the price of oil. So again, non-farm payrolls is still the biggest figure that's released on a monthly basis. Again, I trade this figure for InterTrader live every month, so you can always watch me trade live figures like the non-farm payroll. I generally don't trade oil. I generally trade the S&P, but again, it's all correlated. If you understand what the non-farm payroll does to the dollar and does to industry, you can trade oil off the back of it. So non-farm payroll, as we know, is released on the first Friday of every month, and it's still the biggest figure that moves the market. The US is still the biggest consuming nation on earth, so their ability to create jobs, therefore go out and spend money, be good consumers, pay the taxes, etc. That's what that's what the entire world is looking at the minute. We're not looking for inflation figures anymore. We're not looking for anything to do with price stability. All we're looking for is growth. So GDP figures, non-farm payroll, employment figures, any other figures to do with sentiment like our Philly Fed or our Michigan figures. That's the business cycle we're in now. But again, oil on its own, as we keep saying, is quite a unique contract, that it has its own releases and figures that we can trade off. But then also we have, again, the non-farm payrolls and the other big figures which can have a knock-on effect to how the price of oil is traded. So oil contracts. Okay, so when we talk about oil contracts and we try to understand what a contract, what a lot means, well, basically it's broken down like this. Okay, so WTI, one lot, one price you trade, it equates to 1,000 barrels. Okay, so there's no real max size you can trade, and again, one lot P&L move on the underlying market is one lot times the risk of 0.1, which is $10. So again, the Brent's very, very similar. And again, as I said to you with gas oil, it's almost double, was over double the price of Brent and WTI. That's what makes it so difficult to trade, because it's such an expensive contract per lot to trade. Okay, so that's why if you need to trade it or you want to trade it, you have to have more capital on reserve, and you have to have quite a tight risk strategy. So if this thing moves heavily against you, you can take on a big losing position. So trading economic calendar events. So it's really important when you're absorbing information from your weekly or monthly reports to put them into your trading strategy. Okay, to take heed of what the market's perception of these figures are. Again, in trading, it's not necessarily understanding what the figures mean. It's understanding how the market will react. So think about what's happening in the business cycle in the previous week or month. Are we expecting bad figures? Are we expecting a disruption in the supply? Or are we expecting a lower than expected stockpile? Because again, if the market's surprised by these figures, we're going to have people getting out of wrong positions, then adding to the market, moving in the opposite direction. So it's very, very important that we always understand the business cycle and what the market sentiment and expectations are, and then trade accordingly. Because again, if everybody's right, So again, it's like if you trade the non-farm payrolls. If it's expected 100,000 and it comes at 105,000, there won't be a big move because the market's already priced in and to a certain extent guessed or speculated that that figure's going to come in higher. Okay, but if it's expected 100,000 and comes in minus 100,000, then again, all them people that thought the market would react well are going to be caught in wrong positions. Then all the people that are reacting to the figure are going to sell. So we're going to have a double effect where the market goes down naturally on the bad figure, but then goes down with people getting out of wrong positions. So that's what, again, is very, very important when trading economic data, that we understand these things, because sometimes it's better not to be involved beforehand and wait for the figure to be out. And if people are wrong, again, you can capitalize on that fear and that mistake by again pushing the market to make these people that are wrong on the wrong side of it experience even more pain. Okay, and get out quicker, and all these things, do affect the market and can again have these big moves. Okay, so again, it's also important to assess the impact of the stats against current market news. So again, it's all very well understanding what the figure comes out as, but what does that mean in the wider economy? So again, it'd be foolish to sell Brent on a bearish IEA report if civil war just kicked off in Saudi Arabia. So again, it's superseded by the overall news. So again, you have to understand what's happening in the wider economy and what other people are looking at, rather than just going off the individual figures. So again, the above scenario is dramatic, but there are times when oil follows the euro dollar nearly tick for tick, and this is where the large traders focus their attention on. So again, and in this instance, the Department of Energy is going to have far less impact. If the big traders in the market is looking at the euro against the dollar rather than just these individual reports. So again, we have to look at the correlations, the inverse correlations, of all the different products that are trading to gauge what the market is going to look at and what impact these figures and these economic events are going to have on oil. So again, it's just a simple graph of what these figures can potentially do. So again, we see the market is fairly bearish. Quite a lot of red candles here. We see the market spike back up in the middle. Then we see lots of very strong selling action, big fat red candle bodies. Then at the bottom, okay, we see that the market data is released. So that's better than expected figures. And then look at all the green candles. Yeah, have a little bit of profit taken in the middle where we see the little red spot, but then green spikes up until the market sells back up and makes a whole new range on the right hand side of where the market's now trading. So that's the impact, yeah, and that's how much that can move the markets. And that's equivalent to about 3 points, yeah, off one figure. So it can move 300 ticks off one figure. That's how much it makes. So before I said, that oil and its different counterparts are quite a good contract to trade if you want to spread your risk and you want to arbitrage. So arbitrage is basically just buying one contract and selling against another. So the WTI, as we talked about before, the West Texas Intermediate, against the Brent, which is the benchmark, the underlying figure, is something we can trade against. So again, it's probably easy to show in the next slide in a graph of how you can do this. Okay, so Brent, that's the underlying market. We can see that's the blue line. So the blue line moves, so we can see it's a bullish chart, moving from a low side on the left to a high side on the right. But what happens is, again, what we're looking for is the ARB. So again, they're going to follow each other because, again, the WTI is so heavily related to the price of Brent. But again, there are times when this price splits. So towards the last third of the graph, we see that the blue and black lines separate. So what we do is when that line starts to separate, we buy the underlying market, which is Brent, always going to be the strongest, and then we sell the WTI, the correlated market. And again, the further they get apart, like here, where we see the first wave point down, yeah, that's again, so we're long this one and short the WTI. So the difference between that is the spread, and that's our profit. So again, if you're buying one contract and selling against another, you're almost doubling your margin. And again, and doubling your money. It's seen as a safe trade. Now you can either trade this yourself by buying the Brent contract or selling the WTI contract, or there is actually an ARB. You can actually trade the ARB itself, so you can buy or sell the spread. Okay, so if you think Brent's going to go up, you can buy the spread. If you think Brent's going to go down, you can sell the spread, and you take the difference of of the you take the profit from the difference between these two lines. So again, it's just another way of trading oil by covering your exposure and risk by trading the arb. So again, oil is probably for me one of the most volatile contracts. It's so heavily relied upon in the global economy that it just is going to be affected by any type of real fundamental news. So that's again why people say you have to be a balanced trader. You can't just purely be a technical trader. Because if you're not understanding what the market sentiment is and why people are forming opinions, you can get caught on the wrong side. So although oil does trade technically, it will react very violently to fundamental information. So again, we know that the FX markets, are still the biggest markets in the world. They're the most liquid. But again, the oil is still a huge market. It's just controlled by less people. Okay, there's only 4 major oil contracts where there's a lot of major currency pairs. That's why there's $4 trillion traded every day in the FX markets. Okay, so again, it's very volatile, susceptible to risk and to downside, so you can never trade more than you can afford. But again, if you understand your geopolitical events, if you understand the wider economic policies and how they affect trade, then oil really is a good contract to trade. So really, in summary, it's a fantastic market to trade due to the volatility. You can trade it both, fundamentally from that view, but with technical levels. It reacts to news that's available to anybody. Everybody knows what news is coming out. And again, we can trade things like the ARB, which makes it a very good contract to utilize the capital that you use. Not many contracts have such tight correlations as things like the Brent and the WTI and the Bonnie, etc. So again, it's all down to you how you trade these particular products. But if you understand your fundamentals, economics, then this is somewhere we could perhaps get the edge. But again, it's all about having the right plan, and it's about having the right attitude, understanding the market conditions, the sentiment, and making sure you trade around that. Alright guys, well that's pretty much an introduction to trading oil. So hopefully that's been of use to you guys. Anyone got any questions or anything they'd like to ask or add to that? Okay, I know obviously people are busy with the Olympics and things to watch. I don't want to keep people unduly. So if there are any questions, please as always, send them through and I'll answer them now. Okay, Tom's just asking, is an arbitrage safer to trade than trading with either Brent or US crude? Well, safer in the respect that you're hedged, okay? So there's going to be less movement when you're trading the spread and an arbitrage than you are by trading contracts outright, okay? So yes, it's safer in that respect. So yeah, good question, Tom. But again, it all depends how long you're looking to hold trades for. And again, the spread is going to move slower, but it still will move. Yeah, potentially, but again, it's all about risk reward. It all depends what kind of trader you want to be. There's potentially, yeah, less risk, but therefore there's less straight line moves, so there's less potential profit to lock in. So yeah, that's quite a shrewd observation. But again, it still does move. But again, it depends what trade you want to be. If you want to be a bit more of a longer term trader, then I would probably say that the outrights are better. But in the short term, the ARB's a good way to lock in profits and then again trade either side, leg out of one side of it and try and make the most of the ARB that you're in. Okay, there's no oil data on Wednesday. Any reason? I'm not entirely sure, to be honest, Bing. I wasn't aware of that, so I don't know, to be honest. I don't control the oil data, I'm afraid, so I don't know why that wasn't out. Maybe it was, I don't know. Maybe it was a bank holiday or something. Is my slide still available? How do you mean, Bing? I'm not quite sure what you mean. Hey guys, anything else we need to add or ask to this? Oh, to download? No, unfortunately, all the sessions are recorded, Bing, so you can go over this recorded session just by where you log on to Omnovia and pick to join this. There's another tab that says recorded sessions, so you can just again go after onto that system after this presentation and then just watch this recorded session. Okay, Tom, what moving average works well with oil trading? Well, again, your standard moving average generally works quite well. So I'd say a 200-day moving average is best to look at with oil. Again, because the markets are quite volatile, you need to smooth out that curve and smooth out the noise. So I'd recommend that really your 200-day moving average is probably the best one to overlay on your oil chart. It kind of filters out the majority of noise. But good question, Tom. Anything else, guys? Anything else we'd like to ask about oil or trading this contract? Again, if you're more into your fundamentals and getting big straight line moves, oil does work well for that. But again, with every benefit a market has, it has its equally strong downsides. All right, guys, we've got some more live trading coming up this month. We're going to do US GDP. We've got a lot of new material coming out. The next sessions are going to be on advanced candlesticks and Elliott wave. So a lot of new stuff you might have heard before. But again, guys, anything else you'd like to ask, I'll put my email address down. You can always get in contact with me. Ask me any questions. And again, there's nothing else you want to